This is a debrief of task 4 from the personal tax first sample assessment. So Mrs. O has the following income for 24-25. So we've got some income from employment, profits from property, building society interest received, and dividends received. We're also told that Mrs. O has losses from property brought forward from 23-24 of 14,320. We're also told that during 24-25, Mrs. O paid 6% of her income from employment into an occupational pension scheme. So that tells us that her income from employment isn't actually 85,100. So we need to take away 6% of that to find out how much she actually received. So take away 6% would be the equivalent of multiplying by 94%. So 85,100 times by 94% means that her income is really 79,994. We're also told her employer paid 10% of her income into the same scheme. Well, that's up to the employer to do that, so that's not relevant for Mrs. O's personal tax. And Mrs. O also paid £150 per month into a private pension scheme. Okay, so the significance of that, remember the government wants people to save for their retirement, so there is a tax benefit if you put money into your own personal pension scheme. So we've got the £150 per month, and we need to multiply by the 12 months, and that gives us a total of £1,800. But remember, that's paid from her net pay. And from a government point of view, for tax purposes, we want to work out, well, how much of the original pay would that have been before tax? So we want to gross that up. So if we multiply by 100 over 80, assuming that 20% tax has been deducted, so multiply by 100, divide by 80, so the gross amount would be 2,250. And we'll need to use that in our adjustments a bit later on. We're also told that during 24-25, Mrs. O paid 22,500 in PAYE. So we need to calculate Mrs. O's net income tax liability for 24-25, entering our answer into the table below. We need to make sure we show all our workings. So for this particular briefing then, we just have our standard blank bit of paper here for us to scribble on, but in the exam you're given a table to put your workings into. So let's remember what we're doing here. So in terms of tax, so we've got 3 different types of tax being mentioned here. We have income from employment, we've got property income, and they're both going to be taxed in the same way. But separately we have interest income, and separately we have dividend income. Now the reason why we're separating these 3 things is because there are different allowances and different rates of tax. So here we are in the tax reference materials, and we can see that in section 1 we've got the different tax rates and bands, but for dividends we have a different rate. For everything else we have just the normal rates. But we also can see that we've got different allowances for whether it's going to be normal income. We've got our personal allowance for that, and then for our savings income we've got different allowances, and for our dividend income we've got different allowances again. Remember, there is an income limit for personal allowances of 100,000, so we just have to keep that in our mind depending on how much income the person in the question is getting. Remember, our approach is that we want to look at all these different forms of income, and then we just sort of stack them all on top of each other. So we start off then with our total income, and we deduct our personal allowance from that, and then we've just got to think about the various bands. So we've got our basic rate band, and we saw the size of that in the reference materials. And then we've got the higher rate band, and we saw that in the reference materials. And then there's the additional rate band for anything above that. So what we're going to do then, we take our employment income, and so we sort of see how much that is and whether it fits into our basic rate band or higher rate band. And then on top of that, we'll stack that and then our interest income, and we'll see whether or not that pushes us into another band. And then potentially on top of that, there may be some dividend income that goes a bit further on top of that as well. So while we're doing that, remember that our personal allowance is deducted before we start doing any of this stacking. But for our interest income and dividend income, any allowances for these are included and in the stacking. Okay, so we just need to be aware that some of this income may be taxed at, say, a higher rate band, but some of it may be tax-free. But that allowance does use up some of the bands. So it's quite useful then to separate these different types of income just to see how much is actually there. So it could be useful in your workings just to separate all these different types of income. So for our general income, so we've got our employment, haven't we? So we saw that we have our employment income, and that's the 79,994 after deducting the payment we've made to the occupational pension scheme. And then we got our property income, so that's the 32,600, but we've made losses in the past, so these losses can be used to offset some of this year's profits. So if we take our 32,600 and deduct 14,320, that means we have an amount of 18,280. So that's our property income. And then we also have our interest income, and that's going to be the 3,540. And then we also have our dividend income, which is the 10,600. Okay. So once we've identified all of these, we can then see what is our total income. So we can see we have total income for those three columns, and the total overall is 112,414. Now, what's the significance of that? That's greater than the 100,000, so that means that our personal allowance is going to be affected. So we need to work out how much of our personal allowance is going to be reduced. So ordinarily, our personal allowance would be 12,570, and we deduct that from our general income before we start doing all that stacking. But because our income is more than the 100,000, that means our personal income is going to be reduced. Okay, so it's not going to be that full amount. So we need to work out now then what is the effect on this. So we've got that income of the 112,414, but remember, after receiving our salary, we've paid some money into a personal pension. And the government says, remember, we want you to do that, we want you to save for your retirement, so we get the benefit of that. So before we work out the impact on our personal allowance, we can deduct the 2,250 that we worked out just now. So once we do that, we have a total of 110,164, and this is now again still more than the 100,000. That therefore implies that our personal allowance is going to be reduced. Now, potentially, if we paid a lot more money into our pension, then we might go down below the 100,000, and in which case we'd still get the full personal allowance. But in this case, we have not paid enough pension, and therefore we still have to have some sort of impact on our allowance here. So we need to take away these two numbers, the 110,000 and the 100,000. So the difference between the two is 10,164. And remember that the rules are that for every £2 above 100, we need to reduce the personal allowance by £1. So we need to divide that by 2. And that means we're going to reduce our personal allowance by £5,082. So originally our personal allowance was 12,570, but when we take away the 5,082, means our remaining personal allowance is 7,488. So when we look at our totals then for the 3 types of income, so we have 98,274 less the personal allowance of 7,488. So our general income is 90,786. Our savings income 3,540, and our dividend income 10,600. So before we start doing any numbers, let's try and visualize what's going on here. So remember, we've got our basic rate band, and then our higher rate band, and then our additional rate band. So we've got our general income of 9786. So that's enough to be taxed at the basic rate band, but also push us further into the higher rate band as well. So some of that is going to be at the basic rate and some of it at the higher rate. Remember, that's the figure after already deducting the personal allowance. And then on top of that, we've got a little bit of savings as well. So we've got some savings income of 3,540. But some of that, remember, there's going to be an allowance, so some of that will be tax-free. And then on top of that further, we've got our dividend income of the 10,600. Again, some of that will be covered by the allowance, but that won't push us into the additional rate band because it's still going to be below the 125,000. So for the boundaries, so when does the basic rate band become the higher rate band? When does the higher rate band become the additional rate band? Well, let's have a look at the tax tables to remind us. So the basic rate band becomes the higher rate band at 37,700, and then it becomes the additional rate band at 125,140. But remember, assuming that we've already deducted the personal allowance. So what is the basic rate band? Well, we saw, didn't we, in the tax tables, our basic rate band is going to be the 37,700. But remember, the government wants us to pay money into our pension scheme, so we can add on a further 2,250 to make the basic rate band bigger, and effectively, therefore, more of our income will be taxed at the basic rate, which is good news. So for our general incomes, remember we've got the 90,786. So we've got our basic rate band. So we've got the combination of these two numbers, the 37,700 and 2,250. So we'll have 39,950 taxed at 20%. And so that's going to be a tax of 7,990. And then of the remaining amount, so we've got a further 50,836, which is in the higher rate band. So that's going to be taxed at 40%. So we've got tax due there of 20,334. So both of those numbers add up to the 90,786 that we had in our table above. Okay, so some of the basic rate band and some at the higher rate band. Okay, and then on top of that, we've got the savings income of 3,540. Now, is any of this covered by an allowance? Okay, let's have a look at the reference materials to help us. So we're a higher rate taxpayer, so we have a savings allowance of 500, and while we're here, there's a dividends allowance of 500 as well. So we have our allowance of £500, which is tax-free. And then on top of that, we've got the 3,040, which is going to be taxed at the higher savings rate of 40%, which is 1,216. So remember, those two numbers give us our total savings income. And then stacked on top of that, we have our dividend income of 10,600, of which, remember, there is an allowance. Let's just fill our notes here. This is the higher rate band, isn't it? And then we have our allowance. So that is, again, 500, which is tax-free. And then we're still in the higher rate band, aren't we, for the remaining 10,100. Okay, so what is the tax rate for the dividends at the higher rate band? Let's have a look at the reference materials. So the tax rate for the higher rate band for dividends, 33.75%. So we multiply that by the 33.75%, and that gives us 3,409. So there's our four amounts that we need to pay in tax. So we've got a total liability of 32,949. Now remember that this taxpayer has already paid 22,500 through employment. So the amount of tax still to pay is 10,449. Now in this particular question, most of the income fell into the higher rate band. But what you need to look out for, though, imagine if there was more income and we were on the border between two bands. So you would have to look out for whether or not some of the income fell into one band and some of the income would go into the next band. But remembering that our allowances are also part of that calculation. So it could be that the allowance might push us from one band to another band. So in our course materials, we have a huge number of questions that allow you to practice this with a variety of combinations of income, some of which will be additional rates, some higher rate, some dividends, some savings, and so on. So there are plenty of questions for you to practice. The more and more you do this, the better that you become at it. So we have hundreds of questions for you to practice.